Well, welcome back everybody to the Global Precious Metal Roundtable. It's been a couple of months since we've all caught up. We are joined by two of our regular guests, Jan Skoyles from the Real Asset Company in London and Ronald Stoeferle from Incrementum AG in Vienna. We're also very, very chuffed to have Koos Jansen joining us from, I believe, Amsterdam. Is that right, Koos?
Yeah, I'm in Amsterdam.
Good stuff. Ronnie, Jan, how are you guys going?
Very well, thank you. How are you?
Good, thank you. Ronnie, what's happening in Vienna?
Everything's fine. I'm unfortunately not CEO yet, like Jan, but I'm working hard.
That's a good point, actually, and a good segue to our first conversational point, Ronnie. Jan, do you want to just tell us quickly what's been happening at the Real Asset Company? We hear there's a promotion for yourself.
Yeah, so I was lucky or crazy enough to be offered the role of CEO at the Real Asset Company a couple of months ago, so I'm just sort of getting used to all of that at the moment. And then the idea is that I'm coming in as we're launching and expanding our current product range. So we're looking at embracing the world of cryptocurrencies and taking how we believe gold investment should be taken to the sort of 21st century by using blockchain technology. So that's my sort of mission over the next 6 months or so.
And can you expand any more on that yet, Jan, or you've got it's sort of still development phase and sort of a watch this space kind of thing?
No, I can expand on it a wee bit. So we're planning on, not only are we planning on accepting Bitcoin for gold and hopefully silver as well at a later date, but we're also in the process of building our own cryptocurrency, which is based on Bitcoin technology, but isn't Bitcoin. It's an entirely new cryptocurrency. And the idea is that we're using this open source blockchain technology on which to basically place gold, and so we can use this technology in order to make the clearing and settlement of gold trading much more efficient, much more accessible, and it can be done in much smaller units, and it's a much more transparent process as well. And this, of course, naturally lends itself to being a gold-backed cryptocurrency. And so this is where we're hoping to take this new product. It was called Goldfish, as I announced on TV a couple of months ago, but for legal reasons we're now not allowed to call it Goldfish. So in terms of watch this space, let's very much watch this space on the name, because I'm having sleepless nights thinking about what the new name of this product's going to be, so that a certain bank doesn't sue me for calling it Goldfish.
Fair enough. Well, maybe we can get viewers of this show to email through suggestions for what that product can be called. I'll certainly put my thinking cap on for you.
That would be great. And actually, we had some suggestions on Twitter, but ideally, we want things that aren't sort of traditional. We want something quite new and fresh. No Latin names or anything, just to sort of hint to some people that have made some suggestions.
Fair enough. Fair enough. So look, I guess if we move on to some of the topics I was going to talk about today, obviously having Koos here with us. Koos, you've obviously built up a very strong reputation as an analyst around, particularly Chinese gold demand and the like. So I thought that might be a good place for us to start. It's obviously a subject that's close to all of our hearts. But one of the slides that you sent through, which I included, which I thought was really interesting, was just the actual sort of level of gold mining in China. I'm going to try and screen share it now so people can see it. Koos, how much has gold mining increased in China? And perhaps more importantly, how sure are we around the integrity of the numbers that you see for Chinese gold mining?
In terms of integrity, it's just the official numbers from the China Gold Association, which is a sort of lobbyist group for the industry there. I must say, not all numbers from the China Gold Association I do fully trust, but these gold mining numbers I do. When it comes to analyzing, you pick your numbers and you fit them together, and through analyzing you kind of see what numbers are real, are true, and what numbers are maybe debatable. But these gold mining numbers are true for sure, because it's been widely accepted, and we just know for sure they mined 428 tons in 2013, and it's estimated that they will be mining 451 tons in 2014. and this has been quite a run-up from 1994. You see sort of an exponential growth in mining, especially in the 70s when Deng Xiaoping had power in China and started the opening up of the economy and started the social market economy. I think back then they also started thinking about gold, expanding their gold mining production, and laying the foundation for for their gold infrastructure, gold markets in that time. And only in 2000 the precious metal market was really liberalized. But the gold mining is really a part of this liberalization of the gold market in China. Sure.
Ronnie, obviously you follow gold equities quite a bit with your job and with the fund that you're running and the like. How much have you sort of looked into, I mean, we all talk about Chinese gold demand, but how much have you looked into sort of Chinese gold mining stats and perhaps some of the companies that are actually doing it? Is there anything that ever crosses your radar?
At the moment, we don't hold any position in mining equities, doing business in China. The reason is that at the moment we don't hold any gold equities. We've sent out our signal quite recently, and for the short, perhaps also the medium term, we're not extremely bullish on gold itself, and especially not bullish on the mining equities, because we're seeing that our signal switched from rising inflation to disinflation again. And as I wrote in my last gold report, the tendency or the momentum of inflation is by far the most important driver for the price of gold. And unfortunately, I have to say, we're seeing disinflation again. Looking at the broad commodity indices, for example, especially gold, especially oil, and for example the gold-silver ratio. This indicates me that the environment for gold going forward in the next few weeks, perhaps month, is not very favorable. And from my point of view, you have to actively time mining equities. I don't think that they're a buy and hold investment.
Fair enough. Ronnie, okay, or sorry, Jan, maybe I'll flick over to you for a second then. Obviously, Ronnie mentioned gold-silver ratio there. We were talking before we actually started the broadcast just on how much or how much quieter things are this year. I know that the real asset company hasn't been around for years, so it's harder for you to sort of track, I guess, annual numbers over a long period of time. But have you seen a sort of really marked slowdown in just gold or just silver, or is it pretty much across the board that people are no longer trading or not trading as much as they used to be?
I think it's similar across both metals, which surprises me a wee bit, because last year around sort of October, November time, we actually saw a real upsurge in silver demand when it had been quieter, when the gold price had been falling. So maybe having said that, it shouldn't surprise me, because actually both prices are quiet, volumes are down everywhere, not just sort of at the real asset company. But what I am seeing is that people are I think the sentiment is generally lower, and because there's nothing happening with the price, it's not falling or climbing. People are just they're just kind of sitting and waiting. But I do feel a level of sort of anxiousness amongst customers, that they are wondering if and when things are going to change and how they're going to change. So volumes are certainly down, but I do think that it's similar across both metals, but I have noticed that we have had more inquiries about people buying coins, which is interesting at the moment, but less interest in buying sort of physical bars or having a bit of a bar.
Fair enough. And how about you, Koos? Obviously, you said you're working with Bullion Star these days. What's the nature of your role there, and what do those guys do, basically?
Well, those guys, the chief executive officer is Torgny Persson, which is from Sweden. He's from Sweden. And after having a successful gold broker company in Sweden, he did one in Estonia, because there was a value-added tax profit to be made, or sort of a loophole for Europeans to buy silver without value-added tax. And then he jumped into the Singapore market, because Singapore also has very favorable tax incentives. So I think 2 years ago, he started Bullion Star in Singapore. and it seems to be a success. And through my work in 2013 on the Asian gold market, yeah, he approached me a couple of months ago by saying, you want to write for us, you want to research and analyze the precious metal market on our side and do nice projects. We have a lot of ideas. And I said, sure. So we're combining our forces now, and it seems as if I'm going to be a part of the team there.
Great. Oh, congratulations. Sounds like a pretty good opportunity. I might move on then to the next slide I was going to talk about, or that I found pretty interesting that you'd put together, Koos. And look, I picked out 3 or 4 charts that you put together. The next one's on the sort of COMEX versus Shanghai Gold Exchange versus Shanghai Futures Exchange and the volumes. A lot of people probably haven't seen that chart. Do you just want to go through that a little bit and explain what it's highlighting?
Yeah. So this is the chart starts in 2002 when the SGE was incepted. In October 2002 it was launched, and the first trading week ended on November 1st of 2002. So that's when the chart starts, and you can see the weekly volumes traded of gold. So it's kind of obvious. Can I see the chart, or because I only see Jan now, it's kind of would be nice to see the chart if I talk about it. Yeah, here. Yeah. So obviously, and as we all know, the COMEX is a big price setter in the gold market, and we see big volumes of gold being traded in futures on margin in New York. But you can see the tiny red bars coming up, and that is China. So the dark red bars are the SGE. Which is slowly increasing, but the lighter red bars is the Shanghai Futures Exchange, which is more rapidly increasing. And the big spike around July 2013 is when it commenced in night trading. So they opened up night trading in Shanghai on the Shanghai Futures Exchange to get more to be more competitive in the times that the U.S. financial markets are open. I don't know. Do you also have the similar chart for silver on hand?
I didn't put it in this slide deck. No, Koos.
Okay, so I made a similar chart for silver, and you can see that in terms of volume in tonnage, silver has already taken over the COMEX on the Shanghai Futures Exchange, which is really interesting. And I'm also watching this, and I was preparing these charts because I'm now closely looking and really excited about the SGE International Board, which is going live in September this year. So in about a month, the SGE will launch spot products for international investors to trade in the Shanghai Free Trade Zone. And it has attracted a lot of interest of banks and all kinds of members worldwide. So I'm expecting to see a lot of movement in terms of volume and market share from the west to the east, starting in September by this international board of the SGE. And the Shanghai Futures Exchange also has plans to open up to international investors. So we can. This is for me really interesting to see. You know, in 2013 we can see a lot of physical gold moving towards the east, which is nice. You know, if you have physical gold, but it's a bummer, of course, if your physical gold is being priced by your neighbors in the west. So what we're seeing now is that they're trying to move the markets towards the east, and I'm closely tracking this. So I'll be doing a weekly report on all the volumes and open interests and all the data that is coming out of the markets in the west and the east to see the shift of the markets, hopefully, I think, from the west to the east.
And that'll all be published via Bullion Star, Koos, or where will
so every end of the week on Bullion Star will publish a weekly wrap up of what is happening in terms of on all these exchanges. So SGE withdrawals I was doing for quite a while now, and I will also be publishing COMEX volumes, Shanghai Futures Exchange volumes, and to see where this chart is going if the East has taken over the pricing power of the West.
Sure. So I guess, Ronnie, I mean, the data that Koos has put together, and I mean, I guess whilst none of us have gone to the same level of input of collating this information, I guess it's very convincing and overwhelmingly obvious that there is this huge movement of gold from west to east. But obviously, as you said before, you're still pretty, well, if not outright bearish, certainly concerned for the next few months. When does the sort of pricing power really start to move east, or when does China and India, really start to set gold prices rather than what we're seeing right now? I know that's a $64 trillion question, but
well, I think that first of all, the Chinese but also the Indian buyers are very clever. They tend to buy very anti-cyclical and not pro-cyclical like the Western buyers, for example. I can remember in Vienna, for example, when gold was hitting 1900, people were lining up on the streets in Vienna in front of the Austrian mint, and nowadays it's probably only a few people going to the Austrian mint to buy some gold at the moment. So I think that's a very fundamental difference between Western buyers and Eastern buyers. I think that we're seeing a fundamental shift from demand. I think nowadays emerging markets are responsible for roughly 60% of all the physical demand. However, I want to stress that it seems that many analysts are only focusing on the demand side and say, okay, the demand is very high, so the prices must rise. I think that this is wrong, because demand is basically not a number. We also have to focus on the so-called reservation demand, and that can be a very high demand and even steady or even falling prices. So that's one thing that I wrote in my last report. I call it a big misconception in the gold sphere, that everybody is focusing only on the demand side. However, I think that as I've said at the beginning, Chinese are smart and probably they're piling up, not only the private people but also the People's Bank of China, and I think it's a prudent strategy to buy when prices are quite low. So I don't think that they are interested in dramatically rising gold prices at the moment. And I'm really glad that Koos joined us, because he built such a great reputation within the last few months, and he's really the expert on Chinese gold numbers. And I hope we can discuss the buying behavior of the People's Bank of China afterwards, because I think that's another part of the story.
We'll definitely move on to that. Anecdotally, yeah, I mean, I can think of a couple of stories to, I guess, back up your comment around Chinese buyers being quite sensible in timing their entry points. I actually read a very good research report by an investment bank, which only came out a couple of weeks ago, which basically said that they expected sort of Chinese demand to just ease off a little bit until we saw prices head back to the sort of maybe $1,250 to $1,200 US range. So that was quite interesting. And yeah, comparing that to what we see in the West here, like in Australia, pretty much no one buys gold at all. Our large super funds, our large investment funds still haven't embraced it as an asset class. And the only time I ever saw anyone write a positive gold article was in August of 2011, when prices were around $1,900. And even then it was suggested that, look, this should never be more than 5% of your portfolio. So I remember actually getting quite nervous when I saw that report, because it was a sign that we probably did need a little bit of a pullback. I would move on to ask Jan a question now. Jan, are you there? It looks like you've popped out for a second, because otherwise, Koos, I will move on to, and I think this is probably really worth you spending a couple of minutes going through. One of the things that I've sort of seen from your research is obviously much more detail on what real Chinese gold demand is, rather than perhaps some of the numbers that the World Gold Council and GFMS and the like come up with. So do you just want to explain, obviously they've got their metrics as to how they calculate these things. Do you want to explain how you come up with the numbers that you do and those numbers there for 2013?
Yeah, sure. So what you're seeing here, the 2,197 tons, is just exactly the tonnage withdrawn from the Shanghai Gold Exchange vaults. And I've written a couple of analysis about this. The People's Bank of China started the Shanghai Gold Exchange in 2002, and the aim was to let the Shanghai Gold Exchange be the core of the physical gold market in China. So this didn't happen overnight, but in 2007 it did happen, and the whole structure was successful. So what happens is that by law, all imports and domestic mining supply have to be sold through the SGE first.
Did you say all imports?
Yeah, so all net import. So you have, to make it not too complicated, but you have multiple trade forms in China. For example, you can also have processing trade. If you have processing trade, that is, you don't need a PBOC license to import gold. You can just, any consumer or merchant can import gold into a free trade zone, for example, Shenzhen. Have it fabricated in jewelry, but it's required to be exported again, then that jewelry. So it's only imported into this little island. It's not imported into the domestic market, into the mainland. So apart from this processing trade, you have general trade, and in general trade, there are the 3 banks have a new license now since last week. So in general trade, which is really gold import into the mainland, 15 banks can net import or can import gold into the mainland, and that gold is required to be sold first through the Shanghai Gold Exchange. That is the law. The law also says that domestic mining first has to be sold through the Shanghai Gold Exchange. So this is a way, and eventually when it gets sold and it gets released, or people buy it and withdraw it from the vaults, it's really easy, this structure for the People's Bank of China, to check the quantity and quality of the gold that is entering the Chinese marketplace. At the same time, it gives us, as analysts, if you understand this structure, gives us the exact same tools, because by looking at SGE withdrawals, we can exactly see how many tons of 49 gold is entering the Chinese marketplace, and it's actually, I'm not going to spend too much words on this because it's a bit of a long story, but the SGE withdrawals equal Chinese wholesale demand. You do have to subtract the scrap supply numbers, because gold can be recycled through the Shanghai Gold Exchange vault. Although once gold is withdrawn from the SGE vaults, it's not allowed to return the same bars. So if it is to be returned into the SGE system, it has to be melted again and reassayed. So there is not a large incentive to just recycle gold on and on and on through the Shanghai Gold Exchange. But obviously it does happen, you know, people sell their jewelry or whatever, and it comes back into the Shanghai Gold Exchange. So for 2013, 2,197 tons were withdrawn from the vaults. Of that, 1,540 tons were net imported. This is confirmed by the SGE chairman Xu Luode. And 229 tons were recycled gold. And that leaves, of course, 428 tons of domestically mined gold that was sold through the SGE. So this is a little bit about the structure of the Chinese gold market, which is in essence really simple, because there is this single entrance point. And this is quite natural if you think about you know, the incentive of the People's Bank of China, who wanted to track and monitor the amount of gold entering the Chinese marketplace and adding to private reserves. So this was their way, this is the structure, and when I found out, yeah, I used the same tools as the People's Bank of China. And I have to add, I also don't think the People's Bank of China is buying gold on the Shanghai Gold Exchange, because all gold on the Shanghai Gold Exchange is quoted in renminbi, and it's more in the interest of the People's Bank of China that you exchange dollars for gold. So they're most likely buying gold abroad in Hong Kong or in Singapore through their proxies, and not through the Shanghai Gold Exchange. I have a lot of evidence also for this, and sources. I have some pretty bright sources in the mainland that confirm this. I'm not doing this alone. I'm being helped a lot by sources in the mainland.
And that's why you say that 2,197 is purely non-government demand, because you think that you think the People's Bank of China basically uses the Shanghai Gold Exchange to know how much gold's coming into the country, but it's not actually where they're buying it from.
Exactly. Yeah.
So
Koos, why do you think? Sorry, Jordan. Why do you think there is such a huge divergence between your number, GFMS, and World Gold Council, whose estimates are much lower, and Alistair McLeod's, which is more than twice what you're estimating? Where does this divergence come from, do you think?
Alistair McLeod based his research kind of on my research and then took it to a next level, but I wrote a really lengthy piece about this. I think he went wrong in double counting certain things. So what you see also is it's kind of double my estimate. The reason for the World Gold Council and the other parties is that they don't really know where the gold being withdrawn from the Shanghai Gold Exchange vaults ends up. So I also had some email correspondence with people from the World Gold Council, and they admitted to me, yes, we see a lot of gold, more gold moving into the mainland, and you see also other analysts saying this, but we just don't know where it ends up. And so point one, it doesn't really matter where it ends up, in my opinion, but it ends up at institutional investors and personal SGE account holders. And also the World Gold Council uses, for their demand number, they look at jewelry sales, but not every jeweler is a member of the Shanghai of the China Gold Association, for example. And there are also, political reasons. I mean, if the World Gold Council, which is the authority on gold demand, if they would come out in 2013 saying Chinese gold demand is over 2,000 tons, that would be just, the world, it would have too much impact in the world. So I think they're really suppressing these numbers. It's the same. I'm sorry if I'm taking too much time here, but if you look at H1 2014, the World Gold Council claims Chinese demand was approximately 450 tons. Though from Hong Kong, Switzerland, and the UK, already 570 tons was net exported to China mainland. And mine supply, domestic mine supply, was 225 tons. So supply is already so much larger than what the World Gold Council says demand is. And the World Gold Council came up with this lengthy report saying, yeah, there's a lot more gold going into the mainland, but it has to do with round tripping and blah 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 blah. But it doesn't make sense. Their stories, I also try to debunk their stories because it's all self-contradictory, and their numbers, in my opinion, don't make sense, and my numbers do. Every new data that comes out, or if the chairman of the SGE does a speech and he drops a few numbers, they always fit in my models. So I'm quite positive about my approach.
Okay. Fair enough. Fair enough. Jan's rejoined us. Your internet's okay now, Jan? Oh, maybe not so much. Ronnie, back to you then. And we spoke about, you said you wanted to get onto the Chinese central bank, and we will do that. This next chart from Koos also mentions official reserves, but if I can just get you to play devil's advocate maybe for a second here. Obviously, Koos mentioned, look, if the World Gold Council came out with a number of about 2,000 tonnes for last year, it would be, too controversial, or it would be too much of an issue. Let's just ask ourselves why. Why is that the case? I mean, even if China came out tomorrow and said, our central bank's got 5,000 tonnes of gold, why would that impact the gold market necessarily?
I don't think that there would be such a huge impact on prices, because they already bought the gold. So in terms of the change in supply-demand picture, I think there wouldn't be a very big impact. It would, however, have an impact on the whole sentiment. But honestly, everybody who knows a bit about gold knows quite well that the Chinese, who have announced the last time, I think in 2009, that they own 1,091 tons, that they are constantly buying, and that they are probably own, like, I don't know, between 2,000 and 5,000 tons. Jim Ricketts told me he could believe that it's even more. So I think for the big picture, the interesting thing is that we're seeing currency wars happening at the moment. We're seeing on a daily basis, more or less, that the ties between China and Russia are getting stronger and tighter. We're seeing that the Russian central bank is every month adding to his gold reserves. We're seeing that the Russian gold production is up significantly.
They actually might take over Australia as number 2 this year.
Yeah,
the Russians might.
I think that's really interesting to analyze. And honestly, I think that everybody would have thought that during such a political stress situation, the price of oil should be up significantly. What happened? It dropped and corrected quite significantly. I think that's also the currency wars that are fought at the moment, because falling oil prices are probably they hit the Russians most, probably because their production costs were up significantly in the last few years. So I think the big picture is really interesting, and we are seeing that this financial warfare between the West and the East, which is mainly Russia and China, I think this fight is getting louder or stronger, unfortunately.
So then, do you think the West is suppressing the price of oil to hurt Russia?
Yeah, why not? I mean, having a look at the production numbers in the US, for example, it's up dramatically. However, on the other hand, I think that they cannot keep it suppressed for the long term, because US oil production is also very, very high priced, so that their production costs, if gold drops below, I don't know, 70 or 65, they will have a problem. But I think that they're at the moment definitely suppressing the price of oil to hurt the Russians.
But this is maybe in anticipation also of something we're going to speak about later. Low oil prices would also mean deflation, right? I mean, yeah. So which is really bad for the United States.
Absolutely. I mean, in our fiat money fractional reserve banking system, deflation is the nemesis for every central banker, and that's also the reason why, especially in the Eurozone, they will try everything to fight deflation. In the US, we're seeing that CPI numbers are at 2% at the moment, but we have seen that quite recently commodity prices and especially energy prices were down. So I'm expecting disinflation in the US, and that will also provide some, for some room for the Federal Reserve, perhaps, to do a bit more, or to
I was just going to say, Ronnie.
Yeah.
I was just going to say, Ronnie, in the short term, the Fed might actually see that as a win because it gives them time before the market really pressures them to start raising interest rates. So there's actually the potential that that's looked at as a good thing. I was going to move on in a second to talk a bit more broadly about sort of monetary policy and the ECB and the like, but I thought we might just have one last slide on China and official reserves and the like. Koos, this is one of your charts as well. So the way I read this, you estimate total Chinese gold reserves in the country are probably somewhere around 15,000 tonnes. Is that about right?
Yep.
And you've got the jewellery base. That hasn't changed much since 95, so that's just a starting figure of how much jewellery you think was in the country at that point, and then everything else is what's been added since then. That's the way to read this chart?
Yeah, that's correct. So somewhere in the past, they stopped doing this in about 2011. In the past, China wrote a lot of really interesting reports about the gold market. You had the China Gold Association report, the China Gold Market report, the STE annual report, full of very important information. And then by analyzing all those reports, I came up with this chart. One number I got from the World Gold Council, which was the amount of gold held amongst the Chinese people in 1995, which was, I believe, 2,500 tons. It was like that's the jewelry base you see in the chart. So I started counting from 1995, and from then I added cumulative mining supply. Then until 2007, every addition to PBOC official reserves, I subtracted from cumulative mining supply because I believe at that time the People's Bank of China was taking in the mining supply because the Chinese gold market or the STE wasn't functioning as the way it was intended, but that changed in 2007. So from 2007, I added cumulative mining supply and net import to private holdings, and from that moment on, pure guessing, because I have no idea how much the People's Bank of China is buying. I increased the amount the People's Bank of China is holding, but this is. I don't have any hard numbers on the buying of the People's Bank of China. This is really the best kept secret in China or in the world. Of course, I also read The Death of Money from Jim Rickards, and he says they bought 600 tons in 2013. We have some anecdotal stories, but I emphasize in my article and also with this chart the increase of People's Bank of China official reserves from 2009. It's just pure guessing, but it's not. I don't think it's really strange to think they have about 4,000 or 3,500 tons right now. So
okay, so we could be.
So that's how I came to this chart. Yeah.
Okay, so allowing sort of for a margin of error there, the total number could be above 17,000, but it could also be closer to sort of 13,000, 14,000, depending on what that actual number for the PBOC is.
If we if we would take the People's Bank of China official reserves number seriously, that is 1,000 tons, we have to subtract 2,500 tons from this chart.
Yep, fair enough, fair enough. Jan, you back with us now?
Yes, I'm here.
Excellent. So we're going to welcome back. We're going to move on from a little bit of gold right now, and I think as much as we're all fairly bullish long-term on gold and probably a little bit cautious about the equity market, we try and make these things fair and balanced. So we should give some congratulations to Janet Yellen and crew. Champagne glasses are out. They hit 2,000 on the S&P overnight. So yeah, I mean, obviously the FTSE's been going pretty well. I think the DAX is near 10,000. Is that right, Ronnie?
Yeah.
So equities, how much longer can this rally run for? Who wants to take
that's one
that?
for Ronnie. I think that's Ronnie.
Yeah, I mean, yeah, central bankers remain the best friends of the equity markets. I think that internals, so lots of technical indicators are constantly weakening. September, October tend to be, from a seasonal perspective, quite volatile month. And I think that the air is getting thin at the moment. For example, we're watching the Nasdaq quite closely. We're seeing that this uptrend is held only by a few stocks anymore. So the market breadth is losing steam. Therefore, I'm not sure if there's going to be a major crash or just a correction. However, talking to equity bulls, it seems that the general, the consensus view at the moment is, perhaps we'll see a 5% correction, but the Federal Reserve will save us anyway and will rescue equity markets, and that's the obvious view at the moment, which makes me kind of cautious. And I think there are lots of black swans happening, not only from a geopolitical point of view. It's also the interest debate in the US. We are seeing the bank stress tests in the Eurozone. The results will be published in October. So I'm not extremely bullish on equities at the moment, but yeah, we have to say that the uptrend is still intact, and therefore perhaps it can go further. I'm not sure.
So that, Jan, that's probably a good segue to you then. Ronnie mentioned Europe as well, and that next little slide that I've put there, which I thought was a kind of a neat little play on words, if I do say so myself. There's Mario Draghi and Janet Yellen, or as I call them, the Drag Queens. Which
You've got too much time on your hands, Gordon.
What's that, sorry?
You've got too much time on your hands coming up with puns like that.
Well, he looks pensive and she looks mad, so it's a little bit different to the champagne glasses thing. But when do you sort of see the ECB probably launching QE? And also, what about what's happening in England directly and Mark Carney and the Bank of England? What's the latest over there?
Well, on Draghi, I was actually quite surprised at how the media responded to his speech at Jackson Hole. I don't think it was as dovish as a lot of the media and a lot of sort of financial outlets portrayed it as. I think they sort of really quickly sort of changed the narrative as if it was kind of, it was just any minute, any day coming, we will see QE just going crazy. I think, okay, fine, we have seen the weakest inflation, where we were expecting to see numbers this week released that show very weak inflation in the last 5 years or so. And I think there are worries about prices that have seen significant declines. So I think QE is coming, but when it's coming, I don't think it's as imminent. I mean, who knows, but I don't think it's as imminent as the press and a lot of people are making it out to be. In terms of the UK, there is a huge amount of political pressure in regard to interest rates and how low they are. It'll be interesting to see what happens. We've got a general election coming up in the next year, and there are two key points around the general election, also interest rates and also our involvement in the Eurozone itself, in terms of sort of the political parties that want us outside of the Eurozone. So I think both of those will affect the central bank's policies here in the UK. Mark Carney is coming under a lot of fire. And I think particularly for inflation figures, I definitely feel that people are beginning to see through the official inflation figures that are released in the UK. I can't speak for the rest of Europe, but certainly there's been a lot of reports showing that my generation are those that are suffering the most from inflation figures. And I think that will be quite telling to see how that affects sort of central bank policy, because of course we're the ones that are ultimately borrowing, we're the ones that are sort of unable to save any money, we're the ones that are impacted the most by house prices, and on the house prices front, that will also impact the way that QE is running at the moment and interest rates, because on one side the government are patting themselves on the back that house prices are climbing so quickly here in the UK, particularly in London, but then on the other side they're having to finance young people that are wanting to buy houses, because we have this really silly mentality here in the UK that we should own a house. And so all of these factors are impacting the sort of the general sentiment, and of course this all feeds back to Mark Carney. But in terms of interest rates, I don't see them rising, particularly in this quarter, I don't think. And in terms of Draghi, I don't think QE will happen as quickly as people read the Jackson Hole speech to say it would happen.
Fair enough. Koos, how about yourself? Obviously, you're in Amsterdam. This next chart that I showed is German 10-year government bond yields, which are now below 1%. I don't quite know where Dutch bond yields are, but I imagine they're very, very close to that. Ronnie, you might have the exact number or no, but Koos, what's the sort of consensus around the Dutch economy right now? Is it getting better? Is it getting worse? What are things like over there?
Well, I can say from my surroundings in Amsterdam, things are looking really bullish. Shops are opening up on every corner. All restaurants are packed with people. But that's just Amsterdam. And Amsterdam is like an island, or there are a few big cities, of course. But overall, the Dutch economy isn't really doing that great. We had negative growth in the first quarter. So it's just our interest rates are also, our government bond interest rates are also really low, but that's just more because other countries are doing even worse. And I think it's the same with, for instance, the interest rates of the United States. That country is not doing really good, but it's the last safe haven, and that's why these and of course QE, and that's why these interest rates are so low. To be honest, I don't track the Dutch economy that much. I'm more focused on things in Asia and the markets and physical gold movement across the world. And so it's in the Netherlands for the last couple of years. It's just muddling through. We had some pretty high unemployment in relative to our history. So it's not doing well, but we're in the shadow of Germany. We're also always being seen as the little brother of Germany. So we're stealing some of those valuable investors.
Was the little brother happy that the big brother won the World Up?
No, we didn't.
But normally Austria is the...
We should have been first, and it was the same at the last World Championship. We also would have been first, but and Spain won, and it's just, man, don't get me started about it.
Hey, you guys beat us 3-2, so I know, but then again, we weren't expected to do much, so that's okay. Ronnie, back to you for a second then.
Sorry, I would have a question for Chen.
About football?
No, not about football.
Football's my specialist subject, Ronnie. I can answer a question on football. It's my specialist subject.
I thought it's shoes.
Oh, no, yeah, you caught me out. It was, yeah. Go on.
No, you shouldn't talk with Austrians about football. We prefer skiing. That's the only sports that we are still good at. No, but
Austrian economics or Austrians in general?
Austrians in general. Jan, what's your view on the Scotland referendum?
That's a great question.
If they would say yes, which it seems a bit at the moment, what do you think would be the consequences on financial markets?
I don't know. It's so. Sorry, let's start again. The problem with this entire campaign is that both sides are unable to tell you exactly what is going to happen, and there's literally nothing concrete at all. We don't even know which currency Scotland would go to if they were to leave the UK. So in terms of financial markets, I suspect in sort of our local economy, in terms of the UK, there'll obviously be an impact on what happens in terms of oil. A lot of our other sort of manufacturing industries will be impacted. I would love to say what I think the impact on the pound will be, but no one actually knows whether or not Scotland will use the pound. On Scotland itself, if they decide to use the pound, that will be interesting because they won't have any impact at all on. It's not their central bank. They're just using then another country's country's currency. So so in terms of how their interest and everything else is impacted, to be honest, I don't know, because there's the debates. You can sit and watch the debates that are happening here in the UK, and all they're debating is who loves you the most. You know, does the UK love Scotland the most, or does Scotland love itself the most? And actually, there's very few things that can say. No one knows what's going to happen to the health system. No one knows what's going to happen to the currency. No one knows what's going to happen in terms of membership of international organisations. No one knows what's going to happen to defence. So I personally don't feel qualified at all to say what's going to happen. And also, I feel I should also just step back and say I'm half Scottish and half English, so I don't really feel I can sort of pledge allegiance either side for the sake of the love of both of my parents.
So you're a winner and a loser out of this either way then, Jan.
Yeah.
Jan, I was just thinking on that currency issue, Jan, it's a shame you don't have your gold-backed crypto ready now, because you could offer it as the currency of the new Scotland.
No, don't worry. It's fine. I've timed it beautifully, because even if they vote yes, then they've got 18 months to leave the UK. So we'll be ready in plenty of time. Don't worry. I've got it all sorted. Alex Salmond and I are having a huge amount of conversations about this. Don't worry. It's fine.
Fair enough. Well, Ronnie, it might not be a black swan for the market, but maybe a black pudding instead. But Ronnie, back to.
Can I ask Jan one more question about the London real estate market, which is so? It appears to be in a bubble. Is this a tipping point at the moment, do you think, or will it go on?
Well, at the moment, we have actually seen a slowdown in the rise of house prices. House prices are still climbing, but they're slowing down, which but there does seem to still be a huge amount of demand for jumping on the ladder. There's also, at the moment, we're seeing a lot of sort of low interest rate mortgages. They're coming up for expiry, so a lot of people are trying to renew their deals that they have at the moment. So I think that will also affect how people are, whether they choose to sort of upgrade to the next house or not, whether they stay put to where they are, depending on what mortgage deals they can get. But certainly in London, I don't see it slowing down, but in the rest of the UK, it is. But you've got to remember as well, all of these figures are coming out of the summer months, when it's traditionally a quiet time to be buying houses anyway. I think when we head into September, October time, that'll be a much better reflection of what's happening in the real estate market. But in terms of London, it's quite scary actually, sort of how just the mentality of people. You hear that apparently for every house that goes up, you have 6 people apply within an hour in order to try and look around that house. And they even say that you don't need the number of the house when you go and look at it on the street, because you'll see the queue around the corner for people trying to view that house. So there certainly doesn't seem to be any let up at the moment.
So those are quite bubble signs, in my opinion.
Certainly in London, but for the rest of the UK, it doesn't sound like that's the case at all.
It's much the same down here, Jan. And in fact, we actually never had a house price. Well, we didn't have any major nominal house price correction when the GFC hit. So the sort of Australian property investor is even more bullish, because they feel even more bulletproof than investors in Europe, the UK, or the US do. Ronnie, just back to you quickly on bond yields and perhaps back to Draghi as well. Obviously, everyone will expect that if the ECB does launch QE, that we'll see even further downward pressure on bond yields. But considering where they are now and the fact that it just seems to largely be priced in, is there not a chance that we could actually see bond yields start to climb if that QE is either delayed or it's not as open-ended as perhaps what the market's expecting? And also a rally in the euro as well.
I think the euro is quite oversold at the moment, and looking at the technicals, I would say that the risk-reward ratio being long the euro versus the dollar is quite favorable. However, I think when it comes to QE in the Eurozone, Draghi said that they might target asset-backed securities, but at the moment they don't have the infrastructure to implement a big QE program on asset-backed securities. So it probably will take some time. For government yields, I'm not sure. I would say that probably, I mean, in theory, that the German bond future can go to 160. That should be the low. I would say that if the crisis really hits the fan, I think they will probably even go lower because people will pile into the safe havens, even though it's stupid. I think that treasury bonds will probably rise as well. But of course, I'm not a long-term bull on bonds. We can see from corporate bonds, from emerging market debt, etc. It reminds me very much of the Nasdaq bubble in 2000. Everybody is furiously buying yield. Every yield that is above 3 or 4%, that's just bought by institutional players. So I think this has at least a bit further to go on. But of course, the risk-reward ratio is highly asymmetrical, so it's not very favorable at the moment.
Understood entirely. Look, guys, we're coming towards the end of the hour. We've probably got 5 or so minutes left to go, so I might just finish going back to the gold price and some more shorter-term stuff, which I know is not easy to predict. But if we just look quickly, we can see that sort of most of the moving averages are still pretty close to each other right now, between the sort of $1,280 and $1,300 mark. Where do we see gold over the next sort of couple of months? You know, seasonality should be relatively favourable. Do we think we're a bottoms in, or do we think another test of sort of $1,200 is coming? Koos, I'll start with you, maybe.
To be honest, I don't spend much time at the price of gold. Of course, I watch it every once in a while. Just a hunch. I don't think it's going anywhere for the next couple of months. I think the things in play are more, you have to see in the bigger picture, you know. Next year is the next meeting about the SDR, about the currencies which are in the basket of the SDR, and maybe the yuan will be implemented, and then maybe the government, the Chinese government, thinks it's wise to disclose their real official gold reserves before this meeting will happen. I think those events will have more impact on the price of gold and on the global knowledge of the importance of gold than technical stuff or supply and demand, which that's just my point of view. But I think this is more of a question for Ronnie.
Jan, how about you before we go to Ronnie to finish up?
I think a bit like Koos, I don't really see the gold price doing a huge amount over the next month or so, but I think there are some, like you say, sort of seasonality favours gold at the moment, but at the same time it's clear that even geopolitical news isn't really affecting the gold price at the moment. You know, when there was even reports, was it yesterday or the day before, that Russian tanks had entered Ukraine, and that didn't even move the gold price anymore. You know, we've got all these huge sort of trauma happening across the world. You know, it's quite terrifying when you look at it and you relate it to past world wars, exactly what's happening, and yet the gold and silver prices are both failing to react to what's happening. So it's something big will have to happen in order to move the gold price at the moment. Upwards, certainly. Downwards, I don't know if it will take so much in order to sort of send it spiraling towards 1200. Like Ronnie said, you know, we are facing disinflation, and we know that from Ronnie's past comments and reports, disinflation is literally the worst possible sort of area of place for gold to be in, sort of environment for gold to be in. So I think there's more chance of it going towards 1200 than it is of it climbing. But overall, I don't see a huge amount to be happening with it over the next couple of months. But I don't know if you guys mentioned this whilst I was sort of out of the forum, but we also need to look at all the sort of central bank buying that's going on, you know, across Russia, Kazakhstan, Belarus. You know, a huge amount's being bought there, and Russia is they're definitely ramping up the gold that they've got, and I think this will start to play out as well, and its impact on sort of generally sentiment towards gold, and whether or not this will play out to impact the gold price, I don't know, but I think there's a lot of factors, including sort of the gold fix that we're going to see being changed, and also, you know, the central bank gold agreement, a new one's going to come into play in the next month or so. So I think there's a lot of interesting things that we haven't really faced before, or haven't faced recently, will be coming up in the next couple of months. So they're all things to look out for in terms of the gold price.
Yeah, I agree 100%. I think the path of least resistance is still down. I wouldn't be surprised at all to see another retest of 1200. And interestingly enough, some people who are definitely long-term bulls and whose opinions I respect have all come out in the last week, sort of warning of some further weakness. So I think that's worth heeding. Ronnie, I might finish with you before wrapping up. Just your thoughts on the next couple of months and leading into the end of the year.
Well, I think there's the nice saying that the market tends to maximize pain, and I think at the moment we're seeing that all gold bulls are definitely wounded and having a hard time. However, perhaps there's some further pain to see, and perhaps we'll have to see some final washout in the price of gold. I'm honestly not sure. What I'm seeing from my indicators is that we're seeing disinflation again, which is a bad environment for gold. This will lead, of course, to more monetary extremism from central banks, and this will be excuse for further QE and further central bank measures. But for the short term, I'm not very bullish. I think, I don't know, making a price forecast for the next 3 weeks doesn't make sense. I think for the next 3 years, of course, the risk-reward ratio is excellent. So constantly accumulating gold at these price levels definitely makes sense. If I would have to call a number for the end of the year, I would say 1,300. Yeah, that's a price level that's okay. And we have to say that since the beginning of the year, price of gold in dollar terms is up, I think, 7%. The miners are up roughly 20%. So that's a quite decent performance. However, nobody is really talking about gold. So seeing this divergence between slowly rising prices, and no media attention is definitely a good sign. So perhaps 2015 will be much better. But yeah, for the short term, I'm not very bullish.
Yeah, I agree with you. I think the negative sentiment and just the general lack of interest in gold as an asset class, as an investment right now, is a good sign. But that doesn't preclude one last washout just to sort of really, as you say, sort of maximise that pain and reset the cycle. Look, guys, I'm going to have to leave it from there. Ronnie, Jan, thanks for joining us as always. Koos, been a real pleasure to meet you and have you here, mate. We'd love to have you back whenever you're available.
Thank you very much.
Guys, let's try and catch up in a month or so.
Yeah, thank you.
Absolutely.
Take care.
Thank you very much.
Bye. Thank you very much.
Bye.
Bye.
Thanks, guys.